Good morning. Welcome to another What's Up with the Market, market status update, 6th of November. Apologies, I've just noticed there's a typo on that screen. It should be 10:30 a.m. For Australian time. The day of the US election, hopefully we're going to get a few more. We've got quite a few people watching instead of watching the US election results, probably early days over there, which will most probably have a short-term effect on the market. But I'll answer the question before somebody asks it, is over the term of a presidency, not much difference between Democrats or Republicans being in the White House. Right, let's just get into some housework before we get into the actual analysis of the financial markets. Reminder, none of this analysis that I'm going to do today is used in SPA3 Investor or SPA3 Trader. And I don't use any of the analysis I'm going to do today to make any decisions in either the public portfolios or in my own personal portfolios, which are predominantly SPA3 Investor. And I'm a mechanical trader, have been for many, many, many years. And I precisely follow our systems. In fact, to change the many years into many decades. Before we get into this, I have to tell you that everything we cover here today is general investment advice and no personal or specific investment advice. Straight into the Dow Jones. Okay, this is a zoomed in. We'll just go back to the COVID crash, probably start around about there. And, it goes back a bit. It's a while ago now, it's some 4 years. There's the COVID crash. So a little bit of a medium-term picture here. COVID crash, rise out of it sideways for quite a lengthy period of time, from around about August 2021 to this breakout here. Remember, we watched those with across all the indices, and they didn't all break out to new highs, new all-time highs at the same time. But now we're above this, and that's that black zone I've got over there. I'm going to keep it there for a while just to give us context and perspective. And just keep an eye on this trend that's emerging out of that breakout at that time. Remember, we're in a secular bull market at the moment. I did that session a few weeks ago, and now we're in a primary bull market within a secular secular bull market. So long term and kind of primary as well as also in a bull market. And in a secondary, you could say, just zooming in now from that breakout period, there's a little bit of I'd call that a secondary and not a bear market. It's a bit of a strong word. When people hear the word bear market, they think panic and all sorts of stuff, but downtrend. We're in a downtrend in a secondary time frame, but very much a primary bull market. And we've got this channel that we've, that I've formed over here, defined here with upper and lower channel lines and a median channel line, this dotted line going through the middle. And then overlaid on that, we've got the SPA3 Investor timing, if you like. Look at that, because this is timing on an index. I know some of our clients use that as a market risk type, overall market risk type timing. But we do know that if you sell out altogether, when you get an exit signal like there or over there, and then buy in when you get a low market risk signal, if you like, it actually has a handbrake on the overall portfolio. But you do handbrake, I mean, in terms of annualized performance, but it does take away some angst and give you a breather. But money-wise, over the long term, you're going to do worse than just continuing to trade your portfolio. And you will, of course, maybe have slightly deeper drawdowns if you do just continue to trade continuously. Right, so we had that entry signal, a bit of a downtrend, still an open trade, if you like, on the index. And here we have another important thing to look at. This is a relative strength line between the Dow Jones and the S&P 500. The fact that this is going down over here, I put a black trend line overlaid on the relative strength line, and there's the moving average there. So confirmation of confirmation of confirmation is that the Dow Jones is underperforming the S&P 500, which is a risk on. It's a term that really means that you should have high exposure to equities in a time when the Dow Jones is underperforming the S&P 500, i.e. S&P 500 outperforming the Dow Jones. So let's have a look at the S&P 500. Volatility is low. It's below this threshold we've got over here, the lower threshold, I think, which I've got set at 1%. So 1% volatility is using ATRVE. and it's that's low, which means another bit of evidence, if you like, a weight of evidence towards being risk on. Channel line we've got here is that the S&P 500 is in the upper half above the median line. If we just go back here, the Dow Jones is also in the upper half of this channel and also an open trade. And just by eyeballing this, you can see that the S&P 500 has got more go ahead than the Dow Jones, which is why that relative strength line on the previous chart was slanting downwards, meaning S&P 500 outperforming Dow Jones. And the last high was here, and I've put two Fibonacci lines on here, one running from October of last year, about a year. There's a Fibonacci there, and that's showing that we have had so that is the magenta line here. There's the 23.6% retracement. So we are well above even a bullish retracement, if you like. If you start getting below 23.6 and getting to 38.2, then you start saying, okay, those are the bounds, and that's a kind of a normal retracement in a bull market. If you get below 38.2% retracement of any period that you choose, any uptrend that you choose, then you're starting to asking questions about where the direction of the market. But I've also put a shorter term Fibonacci here, and that is retraced to a 23.6 and looks like it's bounced off it, and that's bullish. So nothing goes up in a straight line, and we had this retracement. I know when we had that drop there, you can just see it, this area over here. Of course, everybody was henny penny, not everybody, but a lot of people got a little bit frightened by that, and that's just one day, which we don't do with analysis. That's why we look at charts like this. So far, so good. Let's move on and look at the cumulative new high, new low. We've got two lower peaks over here in the S&P 500, but the cumulative new high, new low is rising. So which means there are more stocks making new 52-week highs than making new 52-week lows, which is also bullish, and there's no divergence there. Looking at the cumulative advanced decline, similar, the advanced decline not falling here, but just a gentle rise on those peaks rising up there. We've got two lower peaks, and we've got the advanced decline line falling, which you'd expect. There are more stocks when that advanced decline line is falling, more stocks falling than rising. Nothing too serious there to look at. Right, a couple of divergences have happened since we last met or been confirmed. This is the number of stocks above the 150-day moving average. This is S&P 500 stocks, and you can see that this is the S&P 500 rose, but there was a decline of peaks here, if you like. So there's your divergence, falling there, rising down here. And of course, that's just a sign of weakness. But of course, it's not the only thing we look at. We're looking at a number of factors here. Sentiment, this is a breadth of market indicator. And of course, we take that all into account. And we will come up with a weight of evidence view one way or the other on the probabilities of the market continuing to rise or not. But remember, this is not used in our mechanical systems. Okay, this is the US dollar index, S&P 500 falling, lower peaks over there, just on those two, on that short period over there in October. And you can see the US dollar rising. Now, those of you who've been listening to these sessions for a long time know that my view is that this is probably one of the strongest single indicators of equities direction, is the direction of the US dollar. And typically they go, so just to have a look over here, when the market is rising, US dollar is typically falling. And but when you get them both going in the same direction, that is then there's a bit of confusion in the market, and we need to see which way that resolves. So we actually do have that at the moment. You can see there's just a slight drop there, and that includes today's rise. So just looking at peaks, if you like, and you can see the US dollar just started falling off there slightly. But you typically want to see these going in different directions, and you can see here what I've done to make this easy rather than look at all the gyrations of the ups and downs of both, is I've smoothed it with a Sirach indicator, which is just a Sirach indicator of the relative strength between the S&P 500 and the US dollar. And this is that green line means that the last signal was back over here in May of this year, and it's continued to show that equities are outperforming with the smoothed indicator outperforming the US dollar, which is positive. So this is a risk on, and one of the ones, if you are going to weight these different indicators, sentiment indicators, breadth of market indicators we're looking at, you would give this one a higher weighting than most. Okay, now let's just go to the Russell growth versus Russell value. Top graph is growth, bottom graph is value. Relative strength line, Ciroc of the relative strength line, this is rising, meaning of growth is outperforming value. That's a risk on bit of evidence in the favor of having exposure to the US markets. Next, we have a look at consumer discretionary versus consumer staples. Consumer staples here, again, with the naked eye, you can see discretionary doing better than staple. When discretionary is doing better than staple, that's also a risk on for equities. That's a positive thing about the economy and about stocks. And with the naked eye, here's the relative strength line that's rising, and the Ciroc of the relative strength line, to smooth it out and make it more obvious, lots of obvious things over here, you can see it to the naked eye, is saying that that is a risk on as well. So another tick for the risk on box. And here we're looking at the put call ratio of equities. I've made it a bit easier just to, rather than look at, this is the put call line up here, I've put a moving average on that. We take a Ciroc of the moving average, and whenever the Ciroc is falling, because that indicates there are more calls than puts out there, that's a positive thing. And whenever the Ciroc is rising, that means that there are more puts going on than calls, which means that this put call ratio will rise. That is a negative for the market. So we've got risk on here as well. And you can see the trend, if you like, downtrend, the channel I've got drawn there with lower highs and lower lows of the actual put call ratio itself. So that's also a tick in the box for risk on. Right, this one isn't. This is one for risk off. And I've got a fairly lengthy Ciroc over here to smooth out this. And this is interest rates. This is the yield on bonds, and sitting at 4.29% at the moment. And that has just turned negative because of this rise over here on a fairly lengthy Ciroc. But the relative strength you can see is rising. So that means that yields are rising relative to equities on a relative strength basis. And that's typically negative for market. When yields are rising, typically stocks fall. But when, you've heard me say this before, if you go back and eyeball this and look at it in a lot of detail, you'll see that the correlation is not that high, not as high as people make it out to be. And then the flip side of that is looking at 20-year Treasury bonds. So this is the bond, not the yield. Remember, the yields and bonds are inverse. They invert each other in terms of direction. And here, because typically markets are supposed to fall when yields are rising, or vice versa, is that you'd find bonds should go in the same direction as equities, but not at the same rate. And so whenever they are diverging, i.e. going in different directions, that's a little bit ominous for what's happening in the market, and they've got to resolve one way or the other. And there's the short term, there's some resolution down there, so that's a divergence of bonds. And of course, we don't know until after the fact whether bonds are going to pull down stocks or vice versa. But it looks like there's been a bit of weakness. Bonds have started to fall. That's why we saw the yields rising, and you saw a bit of weakness in the market over here, which has got to happen. But most of the time, so I've just indicated on this chart when they've diverged, i.e. going in different opposite directions, and the rest of the time where those aren't shown, you don't see these trend lines shown, that's when they're going in the same direction. Okay, onto the fear index, the VIX index. We're getting higher lows over here. So it's and there's definitely an upslant here. I've got this gray trend line. Sure, this black zone goes back a long time. So I've got an extreme zone above the red, and I've got this black zone over here, which kind of shows where the VIX spends most of its time. But just on the recent chart over here, going back to beginning early last year, March 2023. You can see there's an upward sloping gray line there, and then in a broader channel within this range, and you can see we're getting higher lows over here, which is just gradually the VIX index is starting to just tick a little bit higher, and that trend seems to be going higher. And of course, that's based on options as well, puts and calls. So a little bit of divergence between what the VIX is saying and what the put call ratio of the equity markets is saying, because the VIX does include other puts and calls outside of just pure equities. Right, page there. On to the NASDAQ. NASDAQ is starting to just gradually over here outperform the S&P 500. That's the relative strength line between the two, a ratio between the two, S&P 500 and the NASDAQ composite. And NASDAQ composite did make an all-time high about 4 or 5 trading sessions ago, only just slightly snuck above that previous high. But to the naked eye, you can see that the gradient of this over the last of the NASDAQ composite over the last 3 or 4 months has not been the same as the S&P 500. So a little bit of catch up, but we do have the CIROC here has turned positive, meaning risk on, just because of the relative strength line starting to rise here. And when the NASDAQ outperforms the S&P 500, that's typically a time of risk on. So that's another tick in the box for risk on. So hopefully you're getting a feel here that risk on has just got its nose in front of risk off at the moment. Now going to the NASDAQ 100, and you can see it's bottomed over here, but hasn't quite turned. That's relative to the S&P 500. And so NASDAQ 100 not quite performing as well as the NASDAQ composite. And you can see that over here, but they're all open trades on SPA3 investors. So not quite risk on. It's not a raging bull market when it comes to the tech stocks at the moment. Right, this is a cumulative new high, new low of the NASDAQ 100. Looking for divergence here. No divergence. These are going in the same direction. Now, there is some divergence in the NASDAQ 100 cumulative advanced decline line. And, excuse me, you can see the NASDAQ 100 rising and the advanced decline line falling over that short period of time, which is probably about 2.5 weeks or so. So that divergence is a risk off, if you like. It's a negative indicator, breadth of market indicator of what's going on. And we saw a little bit of that on the S&P 500. So just a couple of breadth of market indicators showing maybe some weakness. And here's another breadth of market indicator, number of stocks in the NASDAQ 100 above the 150-day moving average. Divergence here as well, the lower peaks. So the number of stocks above the 150-day moving average falling, declining there, while the index, the NASDAQ 100, rose. Now, not all breadth of market negative divergences end up with being resolved as the market falling. Quite often the market continues to rise, but you can see instances here. I've kept these divergences here. There's some market weakness there. Here there wasn't, continued rising. There was some weakness after that period over there, even though there was a spike up here. And you can see doesn't mean this divergence. You may, and there's others you can go back. So you can eyeball these going back. I think I may have done a few more going back in history, so you can use that as a training lesson when you download this analysis, which will be available this afternoon for you to import into your instance of Beyond Charts. Right, this is the semiconductor sector, and what we're looking for here is for the semiconductor sector to outperform the NASDAQ 100. So this is a relative strength line against the NASDAQ 100, and you can see for some time this has been declining. The 55-day moving average declining. That's the green line. The blue line is declining, and you can see this. The trend line is also declining. So that means that the semiconductor stocks which is the sector of the NASDAQ 100, is underperforming the actual wider NASDAQ 100 index, which is typically a risk off. When semiconductor stocks within the tech sector are outperforming the NASDAQ and the NASDAQ's outperforming the S&P 500, that's when we get the best kind of bull markets. When this does turn, we should see the CIROC indicator, which is the CIROC indicator of the relative strength line, rising. We don't have that yet, so that's why I've got this last red line here as the last signal that occurred. Signal, not mechanical, just signal. Now we look at the All Ordinaries. All Ordinaries is underperforming the S&P 500, which is what you would typically see when there's a bull market, a stronger bull market going on. So this is a tick for the risk on, and with a bit of a retracement here on the All Ordinaries index, but an open trade and a gradual, gentle uptrend. But the uptrend, as seen by this relative strength, this ratio here against the S&P 500, has not been as strong as the S&P 500. And you can see that in the actual percentage gains between the two markets. The Aussie battler, the Aussie dollar, has been in a pretty steep downtrend against a stronger US dollar, and just an uptick here with the slightly weaker US dollar that we saw in the US dollar basket chart just a few charts ago. So a little bit of strength here, but in this bigger picture, this wide ranging downward trend been going on for some time, snuck out above the upper channel line, the upper downward slanting channel line over here, but then back into the range. So this long-term trend, which has been going since February of 2021, so 3.5 years plus, is still continuing. And just looking at some of the international markets, the Nikkei had strong market into this line over here, all-time high, and has really been confused and found uncertainty gyrating around it since, what is that? That's February this year. So trying to establish this is an arm wrestle going on between buyers and sellers on the Japanese market. And you can see what that's resulted in is underperformance against the S&P 500. And that needs to resolve itself. There was certainly one big sell-off over there, but buyers came rushing back in. But the arm wrestle has continued for the last couple of months. The DAX, there's its all-time high there, that black zone, and stayed above it and struggled a little bit going sideways here for, since May this year. And not raging, but certainly a gentle uptrending bull market. FTSE has been a dog for a long time. This high over here, the zone I've got here, stretches all the way back to, there it is over there. That goes all the way back to, look at this. This is 1999, 2000. So it's only slightly above its peak that it reached in 2000. That's there in 2007. This year's in 2013 when we had the secular bull market breakout on the US markets. And you know what the US markets have done from April 2013. They've rocketed right off the top of the chart here. This is the FTSE. It's done absolutely nothing, relatively speaking, and has been underperforming world markets for a long time. Just an indication, looking at the buffer bars to what's might be going on in developing markets. So we just keep an eye on this in case there's a big breakout in developing markets. Developing markets start taking off as opposed to developed markets. And it's had a good. There's its high just relative to the FTSE. That's the high that is achieved in 2000, March 2000. That's the breakout there in September 2013. Not as strong as the developed markets, denoted by the S&P 500, but certainly being an uptrend. But this long sideways, wide-ranging market, akin to what we've had here in Australia as well. Not as strong as the US markets, and you can see these underperforming relative strength, underperforming line down the bottom over here. So just keep an eye on that in case it does, or when it does break out and start outperforming developed markets. I spoke in the last session on the Chinese index of the skyscraper traits that it has there, certainly. And I think when we met, it was the 9th of October. So that was, wrong one. The 9th of October was round about there when we met. So that was, we probably had the data there from the 8th of October. And that skyscraper effect has certainly come into play. But what we've got to look for here is whether this continues to fall or not. That's a positive day there, positive session in the last session on the Chinese markets. But if you go back and look at what's happened, we get these similar to here. There you get it, the skyscraper, indecision, fall away. It's skyscraper, a little bit indecision, fall away. Skyscraper, indecision, fall away. Probably not so, bit more volatile indecision in that period over there. When you zoom in, you can see that the indecision becomes a bit more obvious. And here we are to date, skyscraper, indecision. It just looks like the odds are in favor of the Chinese market falling away rather than rising strongly from here. But doesn't mean because that's happened in the past more often than not that it's going to happen in this instance, because we don't need to know what's going to happen next. But just an observation, looking historically at some of the characteristics, if you like, of the Chinese market. Quickly move on to this is the all share Shanghai index. So that we looked at was the large cap stocks in China. This is the all share index. So it came from a much lower low, and it is that's really is a skyscraper going from 2,700 to almost 3,700, 1,000 points on 2,700. And we'll see what happens from here. But the last session, as I said, positive, and that does indicate that maybe there's going to be a bit more strength than weakness. And lastly, the South African market, it is into all-time highs, but just like Australia and Brazil and the FTSE for that matter, this long, wide-ranging sideways over the last 3.5 years, without dividends has really tested short and medium-term traders. And the best strategy for these kinds of markets just in recent times has been buying and holding ETFs. But, we know that doesn't work when we eventually do have the inevitable 50% to 60% secular bear market. When it does come, is buy and holders of ETFs are going to get smashed in that time, and they're going to be really confused about what they do, because when we do get that, and I talked about this in the secular bear market session, bull market session, is that when we do get that secular bear market, being active in the markets and having some kind of timing mechanism is the only way to go forward. Otherwise, you could sit for years being lower than your all-time high in your portfolio, like we had from 2000 to 2013. Right, so that completes that. I'll just quickly have a look at the S&P 500 equal weighted index. There it is, just got the recent data in. That is, now this is equal weighted, meaning that small and mid-cap stocks have more of a weighting in the S&P 500 than in the S&P 500, which is market capitalized and it's weighted by market capitalization. There's no weighting in this index, and so it's rising and it's in a gentle uptrend. It's I'll just get rid of this value line so it doesn't confuse things. Is that we do have a risk off over here. It's typically better when small to mid cap stocks go raging as well with the large cap stocks. That's when we have the best kind of bull markets. And at the moment, we don't really have that, haven't had it in place for some time. They've threatened from time to time. This is the mid cap. There is the, just zoom out a bit over here. There was the all-time high for the mid cap, got above recently, fell below, had this rise up. So there is a zone that I've put in here, this blue zone. There's the all-time high. What we really want to see is for this bull market to take off, if we have the Christmas rally, now that we've got September and October behind us, is for the small and mid-cap stocks to come rushing in. And they did for a while in this period here, but and even over here, but they seem to peter out every time there's been some strength. So this is what we've got to keep an eye on. And this will be, in my view, the biggest strength. This and the US dollar, the direction of the US dollar will be the two biggest indications of where the markets go from here. So just quickly looking at the small cap, there is its all-time high. It never got above its all-time high like the mid cap did. It's going all the way back to, what is that? That is November 2021. So some 3 years ago is when it made its last high, and hasn't got above that yet. So this long, wide-ranging, and you can go back and look for periods like this, and there are few and far between to have this such a long period going sideways like this. So something's going to happen, either up or down, and the longer this goes on for, the higher the probability is that breakout is going to be quite severe, severely good or severely bad. Right, let's have a look quickly at commodities. No, nothing happening here in the CRB index, just really going sideways. Gold is the standout talk. There's the all-time high that was reached in August of 2020. Had a few attempts, broke out. There was a strong breakout. We said so at the time, and it's continued to rise. The gradient of the channel is slightly flatter than what it has been. That's not a bad thing, and you can see gold outperforming equities. Silver is yet to get above its all-time high. That was also, I think, back in that was in April of 2011. But this here, I think, is the August. It's August. That's September 2020 there. And gold is, so that's the comparative period. Gold is outperformed. But as I've said before, What's supposed to happen is that when gold really gets going and the gold bugs are in, and everybody believes is that silver catches up. And the fact that silver is not catching up at the rate at which gold is going up just indicates a little bit of disbelief in the gold price trend. But the gold price trend taken on its own is pretty strong. Oil, nothing to really point out here. There's all-time high achieved back in March of 2011, and again here bounced off that a few times in June of 2021, and is snuck above it, fell below into the range, but is threatening, and it's going to be really interesting to see because the long-term trend is up. And you kind of think, well, sorry, this is not gold. This is not oil. This is copper. And you kind of think with copper that the price and the demand for copper right across the board in all industries is that this should make a new high and have some kind of trend similar to there or even back over here, just with the massive demand there is on copper. But that hasn't eventuated yet, and we are seeing it fail every time it gets to its all-time high, and that has been going on for 3.5 years now. So this will be really interesting to see and watch if it does get back to this zone, this black zone here, as to what happens, because its breakout could be similar to what gold is, in which case that could be the catalyst for small and mid-cap stocks to start going around the world, and particularly in Australia. So we watch that one pretty closely too. Oil, there's nothing really to write home about here. It's just going to keep. There's a lot of fundamental reasons and discussions, and there's arm wrestle going on worldwide. Obviously with fossil fuels and the like. But it certainly is being used and used a lot. And as a commodity, we should take note of its price. Just to finish up quickly on the commodities, on Bitcoin, hasn't broken out to a new high yet, has really bumped its head on the ceiling, and when it does break out above, it's going to be interesting to see what happens. So the first time it got to that high was November 2021, 3 years ago. Massive retracement, big uptrend, sideways. So this is consolidation, and the longer this consolidation goes on, it'll the sharper and the greater the breakout is going to be. And it should resolve itself in the direction of the previous trend, which is leading into the consolidation, which was this trend coming in over here. So we've broken below the lower channel line in this period of consolidation. We've got a box, a rectangle forming over here, and we've had 1, 2, 3, 4, 5, 6, 7, probably say 7 or 8 attempts to break above that all-time high of 3 years ago. Markets take a while to resolve themselves. They're patient. They're far more patient than what we are, but keep an eye on Bitcoin. This should, based on the analysis, resolve to the upside. And when it does, if you're in this space, you want to be on it. And Ethereum is dragging its heels relative to Bitcoin. There's the highs back here, a similar period, May 2021 and November 2021. But this is definitely not looking as strong as Bitcoin. But when Bitcoin goes, some of the major cryptos should follow. Not should, I didn't say will, definitely, maybe. But if this does follow, the opportunity may be in Ethereum. It's more accessible, and I guess you can buy it to 8 decimal points in Bitcoin, so it doesn't matter. They're all pretty flexible and accessible. Finishing up on the commodities, the last is uranium. It's dragging its heels along the bottom channel line over here. Obviously, there's a lot of fundamental discussion in this area, but the trend is up. In iron ore, this $90 to $95 zone continues to hold support pretty strongly. It's bounced off that, but the trend is down. And here, thermal coal seems to be forming a base at a higher level here. And you can see this wide-ranging come back into the range. But this is one of the strongest base areas that it's formed on the data we have going back a quarter of a century. And that's good. Happy with that. Happy for bases to form, a bit like Bitcoin is at the top. This is at a big retracement, quite a volatile commodity, and is forming a strong base over here. seems obvious around the world that coal's still being used on a massive basis and is not going to go away anytime in the near future. Right, so just to summarize, we'll go back into the S&P 500 and just summarize and say that this uptrend continues. We're in a primary bull market within a secular bull market, and it's certainly a market to be in. There's no doubt about it. The two real money portfolios that are managed, the US unleveraged and the US leveraged, are in uptrends. The leverage just hit an all-time high over the last a high over the last 2 years, and it's creeping up on its all-time high after its big retracement that it had in 2022. Okay, sorry, Therese asked if I could comment on uranium. I've done that, and it's just bouncing along the bottom of the lower channel line, as you saw in the chart. Bruce has asked, care to comment on risk compared to sparse investor ASX giving mostly sell signals over the last 3 weeks? Yeah, good point, Bruce. So what Bruce is talking about there is that we've had sell signals on the ASX on the market, on the Australian market, but we did have some sell signals on the US market as well. But the public portfolio, and I think most of your Australian portfolios wouldn't be fully invested at the moment, whereas the US are either fully invested. Mine certainly are, and the public portfolio is fully invested. Sell signals haven't occurred, and then when they have, there's been a replacement almost immediately. So I think that's an indication. You saw it in the charts. You saw the all ordinaries and the ASX 200 as well would be the same, underperforming the S&P 500. If you look back over the last few years, I think the annualized return between the two has been, particularly without dividends, has been massively in favor of the US, and even with dividends, the US the annualized returns are also much greater in the US than what they've been in Australia over the last 3 years. So that's all I can say, Bruce, is that the Australian market's lagging, and typically it does, and it does when commodities are not running, and when commodities are running, but the ones that are relevant to Australia, that's when Australia gets outperformance on the US markets and gets Nasdaq like type performances. But that's been a long time since that happened in Australia, and some have even said it may not happen again. And the last time it really happened was 2003 through to 2007. When we matched the Nasdaq and outperformed the S&P 500. But a lot of that was small and mid-cap resource stocks, and they are not running at the moment. And we keep an eye on copper for that. Okay, and yeah, Bruce is back. That's private. We'll talk about that some other time. Okay, that's it. I wanted to summarize and leave it at that. It's still markets to be in here. I know it's been a bit of a sideways and in and out and tough market to trade in the Australian market for the last over 3 years. It's been quite a wide-ranging sideways market, and that's not good for trend following, because trend followers prefer obviously trends to be in place. But the longer this goes on, the greater the probability is the breakout's going to happen strongly to the upside or the downside. And no matter which way it breaks out, you really do want to be a trend follower then, and not a buy and holder. That's why we do what we do. So it's still risk on and time to be in these markets. And relatively speaking, to a secular bear market, well, they're just terrible to live through. And we're not in a secular bear market at the moment. We're in a secular bull market. So we want to be exposed and continue being vigilant to the markets, because when that secular bear market comes, we want to exit. We really do, because you don't want to sit through and be sitting on your hands and caught napping, and suddenly the markets are down 30-40% and you've done nothing because you're sitting in buy and hold ETFs. I mean, that's the value that we get out of being vigilant and watching, keeping an eye out for our signals, because that's what we want to avoid, and that's where we get massive outperformance, relative to the indices and to buy and hold ETFs. So I'll finish it there. No more questions. A couple of comments. Thanks, Wayne. Thank you, Mark. I'll finish it there, and I'll be back in a month with this, with another market status update with what's going on in the markets. And in a couple of weeks' time, we'll have a look at the portfolios again and see how they're reacting to these markets. So until then, I wish you consistent, objective, and peaceful active investing.